We believe that banks are the safest place to save our money. But what if this assumption doesn't exist anymore? What if banks are showing good numbers in their financials by manipulating rules and regulations? But in the reality, the story is quite different. What if I'll tell you that only fraction of your total deposit is 100% safe, which is covered under deposit insurance guarantee, and the rest of your money depends upon the performance and the quality of assets these banks have in their books of account. In Nepal, up to 5 lakhs is covered under deposit insurance guarantee of each natural person depositor held with commercial bank and financial institutions licensed by Nepal Rashtra Bank. But what if you deposited more than 5 lakhs? Right? Central bank will take no guarantee if that bank will goes into bankruptcy. In this video, I am going to share 6 reasons why I think Nepalese banking system are creating big bubble and it's getting bigger and bigger. The first reason why I think Nepalese banking system are creating bubble is business exists only on the paper. A very considerable portion of small and medium-sized enterprises loan are taken by those businesses which exist only on documents but not in the reality. Those businesses are only created to take loans and not to do business. Even there is no actual capital investments outside of business registration documents. They are showing their business operations by buying and selling only bills instead of actual product and services. If they have more loans, they have to show more sales. To show more sales, they have to purchase more bills so they can adjust tax payable on sale against tax credit on purchase. By using those bills, they are able to show more sales without paying tax on sales. A single bill is routed throughout numerous time to justify their business loan. The second reason why I think Nepalese banking system are creating bubble is collateral overvaluation. Most of the SME business loan repayments are solely depends upon the collateral. It won't be wrong to say it's not a business loan, but it is a loan against collateral. Mainly 2 ways collateral are overvaluated. First is by valuator who overvaluated the market value of that property, and second is if the property is newly bought, then putting more daily amount to increase government valuation of that property. Even there is no overvaluation of collateral, still in this bad economic situation, property valuation are going down because there are no buyers in the market. Banks are facing tough situation to find a buyer to sell those collaterals to recover their loans. Banks are offering loans to those buyers to buy those collaterals so they can recover their loans. So you can imagine how these multi-chain traps will affect banks in the long run. Third reason is misutilization of loans. In simple word, misutilization of loan means not utilizing that loan amount for the same purpose it's taken for. In a small survey, we have found that more than 60% of small business loans are misutilized and diverted those funds in riskier investments like buying more properties to take more loans, putting that amount in meter biazi to get more interest rates. The horrible thing is, I have heard some bankers saying that as long as we are getting repayment installments, it's all fine. We don't care whatever they do with that money. Dude, it's not fine. It's against business lending. Because the most important thing to look at in business lending is business positive cash flow. Because from that cash flow, they will repay that loan amount. They are paying you now because they have loan money left in their bank account, but once it will be expended, the loan will start defaulting from that day. The fourth reason why banks are creating bubble is same business is documented to take multiple loans with multiple banks. These types of practice mainly found in small trading business and agricultural loans. Like if the business is about fisheries, then same ponds used to be documented with different banks by just making lease agreements. Or if that business is about livestock or small trading shops, then they are just changing hoarding boards and documenting those business with multiple banks so they can't track. The first reason of bubble creation is customers are taking new loans to pay existing loans because they have misutilized their loan and diverted those loans in some other riskier investments, and in this bad economic condition they are not able to get a return on their investments. So now there are many customers who are looking for new loans or loan addition to pay their existing loans. Banks are also offering them or giving them loans because they don't want to make provision for their existing loans to show clean records in their books of account. These things are mainly happening through loan swap, new document based business creation, and showing good amount of sales of their business by purchasing bills. The sixth reason is banks are showing exaggerated deposits and lesser provision by using window dressing techniques. There are mainly four techniques used to show more deposit than actual. The first is multi-layering in interbank call deposit or call accounts. Call deposit is a system which facilitates interbank short-term lending at interbank rates. For example, Bank A provide call deposit to Bank B to Bank C to Bank D, and Bank D to Bank A. And by doing this, by multi-layering in this chain, every bank used to be able to show more deposit and more lendings in their books of account. Second is a set of activities to increase deposits by help of Nostro and Vostro accounts. Nostro account is domestic banks open its bank account in overseas bank in foreign currency to facilitate overseas trade and commerce. Third is to show more deposits, banks are taking inappropriate advantage of NRB lending against CLR and SLR policies. Nepal Rashtra Bank provides loans to banks against their CLR and SLRs in extraordinary situations, but banks are using those facility to show big numbers in their books of account. Fourth is banks are making their employees ask for deposits to their friends, family, clients and relatives. There is nothing wrong asking deposits with friends and family, but they are using this practice only to show big numbers of deposits at reporting period and averaging it. And the second part of sixth reason is banks are showing lesser provision than actual. Every central banks provides parameters to recognize provisions by considering types of loan, classifications, time, risk, and loan can be categorized as standard, substandard, doubtful, or lost assets. And according to that, provision have to be made in their books of accounts. The thing is, to reduce the burden of provisions, banks are in practice to restructure the loan where provision of burden is low. Like bad category working capital loans get converted into a new term loan. To show lesser provisions, practice of manipulation in capital adequacy framework can also be seen here. Capital adequacy ratio is also indicator of a bank's ability to handle certain amount of loss before risk of becoming insolvent. If you want to know detail about how manipulation is being done in capital tiers, risk weights, or whole capital adequacy ratio, let me know in the comment below. I will make a separate video for that. The new monetary policies of NRB is quite a strong step by Nepal Rashtra Bank, but if we apply those policies, more than 80% of SMEs loan will not qualify for renewal. So banks are already in practice to restructure those loans rather than renewal. So these were 6 reasons why I think Nepalese banking system are creating bubble. I can't put exact date, but bubble is already created, and if this practice will continue, it will burst very badly and it will affect every Nepali people, mainly the depositors and shareholders of those banking sectors. I am not against any particular banks or particular bankers. I am afraid to see the results, because if it will happen, the biggest loser will be small stakeholders, because big fish will already take a side before the fall. That's why there is a concept of too big to be fall. Make banks that large, so even in the time of liquidation, government have to save those banks to maintain the trust of the public in banking sector. But the cost always have to bear by common people. And thank you so much for watching till the end.